Welcome to the Market Recap, your weekly digest of the biggest market stories from the past week. Join host Anna Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Anna Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us for yet another market recap. I'm not joined by my normal co-host, Bruce Campbell, today. I'm actually joined by Jordan Youl with Stonecastle Investment Management. Thank you for joining me, Jordan.
Yeah, thanks for having me. It's good to be back.
It is. We had a little hiatus, but we're back in business. I'm just going to start off by saying today, I think there's so much to break down. And I think there's a lot of value that you can bring to the table as far as what's going on, how that affects the small cap space. I know we're getting lots of news about how this is affecting the markets as a whole, but we're going to talk about how this affects the small cap investor and what you think this might mean going forward for investment opportunities. So we're going to take a bit of time today. We're not going to make this as quick as normal. But stick with us because there'll be lots of great stuff that comes out. We're going to obviously talk about Russia and Ukraine. This is, kind of the story of the year. Hopefully it's not a story for too much longer. We're going to talk about a commodity shock that we're seeing in the markets. Of course, we're going to break down investor sentiment. That's obviously very important. And then, of course, get into some CSE issuer news. And that's where we're really going to break down, what we're seeing in the small cap space and how people are reacting to it. So stick around to the end. Jordan, let's just start. Russia and Ukraine. What do you think?
Yeah, well, it's definitely kind of wreaking havoc on a majority of the equity markets, especially the European indices, this week in particular. But, 2022 in particular has been quite a volatile year to begin with. Obviously, there's a lot of cross currents that we're dealing with, but this invasion this past week into Ukraine has definitely caused an uptick in market volatility for equity investors, especially domestically and European from that perspective. But that being said, we are seeing a tremendous amount of opportunity in the small caps, which we'll touch on momentarily. But some other emerging markets, whether it's Brazil, Saudi Arabia, South Africa, and even Canada, a lot of these commodity-rich regions are actually performing very well this week in light of the negative news that is obviously affecting the Ukraine.
So first of all, let's just talk about Russia for a moment and kind of the capital markets. They actually, their stock market was shut down for a period of time. I'm not sure the status of where that's at now. The MCSI and the FTSE Russell are cutting Russian equities from widely tracked indexes. The London Stock Exchange suspends dozens of Russian depository receipts from trading, isolating the stocks from large segment of the investment fund industry. We're really seeing the stock market in Russia was shut down, and we're seeing the kind of the global markets react quite aggressively to this, right?
Yeah, it's definitely having an immediate impact for sure, especially with the Russian economy. There's a lot of U.S. denominated ETFs that track Russian issuers, and that ETF in particular, the MSCI Russia ETF, is actually down 68% this week. The ruble, which is the Russian dollar, has been impacted as well. So it's definitely negatively impacting the Russian economy for sure. But what's a little bit more concerning is the ripple effect it might have into the surrounding European regions. And one region in particular that really stands out, that really depends on the Russian economy because of its natural resources, is Germany. So obviously, we're monitoring that very closely, but without question, these sanctions were aggressive, and it's definitely really kind of chokeholding the Russian economy for sure right now.
I mean, I don't know if this is fair to say, but, I think of, there's lots of Russians out there. This is affecting Russian families that might not necessarily agree with this movement that's happening with the invasion. And, they're in lineups to go to the banks and try and make sure that they have money to buy groceries to feed their families. And they have investments for retirement that are probably, who knows what the recovery would be. This is impacting a lot of people. I was shocked to hear that the Russian economy is smaller than Canada's economy. That surprised me. I guess when you have these land masses that are this big, you assume, but it's not necessarily a global leader from a size standpoint of the economy, right?
Yeah, that's correct for sure. And, like I said, a lot of the European regions like Germany that lean more on the Russian economy are going to be more impacted than, say, the US, right? So the US actually imports from the Russian economy. It's very little on a percentage basis. It's about 1%. So there's going to be different geographic regions that are going to definitely be more impacted than others. But just going back to, the investor, if they're at the ATM trying to withdraw money or convert their local currency into US dollars, they might have issues there just because of the fact that a lot of these financial institutions do have sanctions and their assets are effectively frozen.
And speaking of the US, a lot of global companies are actually leaving Russia altogether, including Disney, Shell, Apple, Meta, Kinross, Ford. I mean, that's a huge impact. That's a huge job loss. That's a huge withdrawal. How do you see this affecting, outside of Russia, these types of moves? What do you forecast how that will affect the rest of the
Mhm.
world?
Well, it's going to definitely change maybe the forecasts and their earnings this year, right? We don't really know what the aftermath is or what the duration is due to these geopolitical tensions and how long the conflict's going to last. But the fact is that a lot of these massive global companies are ceasing operations, they're selling assets, they're leaving Russia, and that is going to impact jobs and growth. So effectively, we'll have to probably monitor the numbers and track this obviously very closely, but the numbers probably won't show up for a couple of quarters. So it'll probably be a second half of the year where we're going to really take a look at the contrast between the expectations for this year and how these sanctions and the decision that these companies are making to remove themselves from the region and how that's going to affect their businesses moving forward.
And you mentioned that, this is kind of affected mostly, Germany, and will kind of ripple out, in the rest of Europe, not as much US. Any thoughts on maybe how this is affecting the Canadian economy? Are we seeing any effects here?
Potentially, locally here in Canada, we've put tariffs on. I think it was around 35%. So we are participating and joining our allies. But Canada in particular, given the fact that we are a commodity-rich region, the TSX in particular is up this week. Small caps are up this week. Toronto's thriving, and that kind of coincides with what we've talked about in the past, where we're seeing a rotation out of the US, which has really been the leader in the equity markets for the last decade or so. We're starting to see a changing of the guard, and the takeaway here is that we're seeing similar characteristics in the markets today as to what we saw in the early 2000s. And we believe that this is a new commodity cycle where effectively emerging markets, including Canada, really outperforms the S&P 500 moving forward, similar to what it did between 2003 to 2007. So the takeaway here is that there's a tremendous amount of opportunities in Canada, and what's changed in our models is, the gold miners, the base metals in particular, the copper miners, they've broken out and they continue to perform really well. And obviously energy's been a hot trade, and financials, which reported this week, had fantastic numbers. So as an investor, if you're looking at where do we go from here, you want to be looking at home here domestically, because there's a pretty significant list of attractive opportunities right now to increase your exposure to domestic issuers.
That's a really good point. And I just want to touch on, we did this fantastic series last year called Mining Over Canada. What we saw is during the global pandemic, it was really difficult for investors to wrap their heads around investing in exploration or mining projects in regions where you couldn't necessarily even get your team in due to the pandemic. I think we've started to see this national investment thesis in investors already. So, and obviously we're a resource heavy country. So hopefully that continues. You mentioned commodities, so let's move into kind of our next topic is a commodity shock that we saw this week. What is a commodity shock and what happened?
Yeah, it's effectively the rate of change in these commodity indices, week over week, for example. So obviously, a couple of weeks ago when we were doing the show, WTI was around $95, and that was a big move in itself. Well, today it's around $112 today. It's up another 23%. So we do have a chart. This is a long-term chart that goes back to the 70s, and effectively we've had the biggest rate of change or biggest update since 1974. It's been 48 years. And this doesn't happen very often, but typically whenever there's a significant shock or a price appreciation in the underlying spot prices in commodities, that bodes well for the commodity rich regions like the ones I mentioned earlier. But we also have to be cognizant of the fact that, other areas in the economy might slow down as a result of this. So, there's pros and cons to it, but the fact that energy and, gold and the copper miners in particular are breaking out after consolidating for quite some time, we think the opportunity set here is definitely in Canada more so than the US, especially with the value versus growth narrative. So this is something that definitely bodes well here locally. But it could have a negative effect from an economic perspective in some time, whether it's a year or two out from now. But it's something that we're cognizant of. But it's definitely bullish for commodities in the near term for sure.
And that kind of leads into the potential of stagflation, right?
It is, and that's a little bit of a fear that the market is anticipating or expecting. So, the data or the economic data from the US this morning was very strong. The US unemployment number was around 3.8. The jobs number was very strong. It definitely exceeded expectations. But the concern is that, inflation is at a multi-decade high. Prices are soaring, commodity prices are soaring. Obviously, there's upward inflationary pressure. And the concern is that the Fed, which is expecting to increase interest rates starting in a couple of weeks on March 16th, that they're going to start increasing rates as the economy might be slowing down. And, a good example of this would be in the 70s, where effectively, the economy was doing well, commodities were performing, but it peaked and the Fed was a little bit behind the curve. So if you go back a couple of weeks ago, the market was anticipating that the Fed was going to be a little bit more, hawkish or more aggressive by increasing rates to 50 basis points in March. Well, effective, today, intraday anyways, that scaled back and there's more of a probability or likelihood that they're only going to increase rates by 25 basis points on the FOMC meeting on the 16th. Now, Fed Chairman Jay Powell spoke about it on Wednesday. The market reacted favorably and had a really strong update on Wednesday. So it's pretty much priced in at this point, but without question, similar to Canada, because Bank of Canada increased rates by 25 basis points this week as well. The market is anticipating that the Fed will start hiking rates, but it'll be a little bit more gradual and maybe not as aggressive as as expected from a few weeks ago. And obviously this conflict between Russia and Ukraine is going to have a bearing on that as well.
Absolutely. Okay, let's talk about investor sentiment. I'm sure investors have a lot of sentiment right now about what's going on in the markets and probably a lot of questions. What are we seeing from an investor sentiment standpoint right now?
Yeah, so there's a couple of ways of looking at this. From a contrarian perspective, it's very positive because we look at investor sentiment from a contrarian perspective, and we do have a chart of the North American Active Investment Manager Index. And effectively, we like to track what the pros are doing, and they're defined as the smart money, where the largest capital is a pool. What is their equity allocation to the equity markets versus a poll, for example, or a survey? And effectively, this tracks the equity exposure from the largest pools of capital. And on the bottom right-hand side, we've annotated in the green circle that the latest level was 30%. So in other words, the pros or the smart money is very defensive and underweight equities right now. And we're at levels last seen in March of 2020 during COVID. And historically, when we get to these extremely pessimistic levels, it's a great buying opportunity. Now, what's changed or what might be different today is the fact that some of these longer term trends are starting to break. And we are cognizant of the fact that we're not out of the woods yet. So it's a little bit challenging from a timing perspective, but it's something that, we're cognizant of. So we wouldn't be surprised if we might see some type of capitulation or strong move in the equity markets over the coming weeks as a result of this. But if you're a shorter term trader or even a long term trader that's just looking for a good opportunity or a timely opportunity to step into a company that you like that's trading at a cheap valuation and maybe the stock price has had a pretty significant drawdown, right now could be timely. But Obviously, what's grabbing headlines is the conflict right now. So that's something that we have to watch day to day. But from a contrarian standpoint, it's definitely positive. But we're a little bit concerned and about just like the macro perspective and the sentiment in the overall economy right now. So it's a little bit of a barbell approach.
Yeah, to say the least. We're going to talk about some CSE issuer news. So I'm going to talk about a few issuers or a brand new issuer, and then we're going to talk about the fundamentals of another. And then we're really going to break down kind of what this means for the small cap space. And I'm so thankful to have yourself give us your thoughts on what to expect. I first of all wanted to welcome a new issuer, Labrador Uranium. They joined the CSE. They started trading yesterday. Welcome to the CSE family. This is kind of a timely topic that we're talking about. Obviously, there's a lot of uranium that comes out of Russia as well. We just had a conversation about, investing kind of within our own country. So welcome. I hope you guys do quite well. They have 3 quite large properties that are obviously in Labrador. And they have some pretty aggressive exploration programs dedicated for 2022. So congrats, guys. We'll be watching you. I know they have a very experienced board, so they have everything that they need for potential success. So this is kind of just touching again on kind of commodities and what we're going to start seeing globally. Are you looking at opportunities kind of within other countries where they might fill a gap?
We are predominantly, CSC, Canadian listed issuers is definitely our focus that might have assets globally. We do have exposure to uranium companies at the portfolio level, and we're really excited about the opportunity set in uranium and other, commodities. But yeah, this is one that we definitely like. We're very bullish and constructive, especially in these up and coming, smaller cap companies, especially with this commodity tailwind. We're going to really see the outsized, returns, especially in the micro cap and small cap, in this current market environment. So uranium is definitely something we like right now, along with the base metals and the precious metals for new ideas. And that's exactly what we're doing at the portfolio level and the changes that we've been making over the last couple of weeks.
It's kind of interesting just to continue touching on commodities and kind of, the resource sector is because of the pandemic, what our typical, global conferences that happen every year have been pushed out. So it'll be interesting to watch this play out and them continue to kind of get those tailwinds and continue to build strength. We're all going to be gathering in places like Vancouver in May for the VRIC conference, and we're going to be gathering this year for PDAC in Toronto in June. So in a way, it's kind of neat that these conferences have been pushed out as we're kind of watching this grow, and hopefully some great success can come from those. I also wanted to chat with you about cannabis. This is obviously not really on topic of what's going on with Russia or what's going on kind of around the globe right now, but cannabis is under some interesting pressures. So tell us what your thoughts are there.
Yeah, so there's multiple factors and why we're bullish and like cannabis. So, at Stonecastle, we have a very strict quantitative model where effectively we have our high conviction ideas where there's a check mark in all the boxes. And, for example, we have energy and metals and commodities on the top end along with financials. But we also have what we would define as up and comers. Companies that have phenomenal growth profiles, trading at, reasonable or attractive valuations, and effectively are improving in our models. And cannabis in particular is a sector that has been, really drifting lower and out of favor for the last 12 months. However, the fundamentals continue to improve. So a lot of these MSOs in particular that I'll highlight have phenomenal revenue growth, trading at more attractive valuations today than they have more recently. Now, the stock prices more or less are at their 52-week low, and the market really hasn't recognized that. And I don't think it's a function of, the company. It has more to do with investor sentiment and kind of what's going on, in the markets right now, because we are in a risk-off market environment. But I think if you're an investor and you're looking for, companies that are growing out of favor and you have a longer term time horizon, and I mean like more than 12 months, you might want to be looking at some of these MSOs. We manage a cannabis fund. We have exposure there, and we're really, excited about the opportunity set, especially in the U.S. And we have a midterm U.S. election as well in the fall. That could be a catalyst to get the sector going. But that's a sector that's out of favor and under owned right now by investors. So it's something that we definitely have our eye on, and something that we definitely like.
Well, and I think that's ideally what most investors are looking for, is something that has fantastic fundamentals, great management team, great business models, has proven execution of their business models, and just not getting the love based on kind of macro events. So those are real opportunities in the market. So what, as a small cap investor, do you think that we should get into?
As a small cap investor, I'd be looking at, from a sector perspective and from an asset allocation perspective, I'd be looking at commodities right now. And then if you're going into something that is out of favor like cannabis, I'd be really digging into, the fundamentals and valuations. And there's a lot of opportunities, especially on the CSC with the MSOs. So I'd definitely take a look at that. But from a macro perspective and what to look for next week, obviously top of mind right now is a conflict. It's Friday today, so we'll see what kind of transpires over the weekend. But we do have another CPI report on Thursday next week to kind of gauge, what the level of inflation is right now, along with the FOMC minutes and the rate decision on the 16th to determine, what the Fed is going to be doing moving forward. So obviously there's a lot of cross currents that are taking place, but despite that, there are opportunities across the board, especially here at home, where as an investor you can capitalize and take advantage of the current market conditions.
Amazing. Jordan, I always love chatting with you. I don't mind when Bruce needs a day off, because it's so great to chat with you. Obviously, with a heavy heart, all of our thoughts are with families in Ukraine right now, and everyone affected by this. I hope you have a wonderful weekend, and I look forward to talking to you again soon.
Yeah, same to you. Thanks for having me.
Thank you, Jordan.